Hey everyone, welcome in to another daily editorial here on the KE Report. We're going to be talking about gold's move up to 2,200, silver that poked its head close to that $26 region has reversed today, and also the overall makeup of March here, where we've started to see silver and the gold equities outperform the gold price, even while gold has been performing quite well. We are chatting with Brien Lundin, editor of the Gold Newsletter, also our host down at the New Orleans Investment Conference, which I will post a link to below. Hopefully, many of you listening can join us down at Brien's conference this year in November. Brien, let's start off with kind of this big picture shift that we have seen in March for the precious metals equities and even silver. Both of those have started to outperform gold. Now, I know that there's a lot of work for silver and the equities to do to even come close to catching up to where gold is at all-time highs. But when it comes to this shift in March, how are you playing it? Do you think this could just be the start of a better environment for the equities and for silver?
Yeah, I really do. I think it's a better environment all the way along. And in fact, silver and the mining stocks have been outperforming gold since the beginning of this run, which really started the last day of February and had that big day, the first day of March. So what we've had so far is, March metals madness, and I think it's going to continue. We've only started in the past few days to have a few pullbacks here and there, but we saw an explosive reaction from gold to the Fed simply keeping their forecasts at 3 rate cuts for the year. So I think that obviously has a big part to play in where we've gone so far in the metals and really all the risk assets out there is investors are finally focusing on the important thing, the basic fact that the Fed will cut this year. The timing of the cuts, when they're going to start, how many they're going to have. That's really the minutia that I think the market had been obsessing over, and in recent days and recent weeks has just started to put aside and begin to focus on the simple fact that we are going from the harshest rate cutting environment, arguably, in Fed history to the rate cutting cycle. And that's going to be tremendous because all of these markets, from stocks to metals and commodities, have done very well during this rate hiking environment. So you would assume that during a rate cutting environment that we go from headwinds to tailwinds, we should do a lot better. And I think that's one of the big factors that has really been driving gold over the past few weeks.
Well, Brien, I was going to ask you what you thought was behind the scenes outside of just the expectations around Fed rate cuts, because really the narrative hasn't changed that much all year long. Everybody's been expecting at least 3 rate cuts. Now, coming into the year, people were much more bullish. They thought that we'd have 7 rate cuts and then 6 and then 5. So that the count's gone down. But everybody knows that, and even the Fed has admitted they're going to be doing some rate cuts by the end of this year, probably loaded in the second half of the year versus the first half. But there seems like there's wild moves sometimes in the metals and cryptos and the general stock markets and the NASDAQ and the S&P. Everything is launching higher. The narrative hasn't changed that much. Are there any other forces at work here that you see from the economic side or the macro side that are maybe giving investors that feeling of let's go ahead and speculate?
Well, generally speaking, we've continued to see really positive economic data. And going by that data, the Fed should not even be considering whether they shouldn't be considering cuts at this point. Even inflation has some indications that it may be having a spike in the near future. So the Fed really shouldn't. And I think that what's prompting them to keep expectations high for rate cuts is the simple cost of servicing debts at these levels of debt and at these interest rates. It's not just the federal debt, which we've talked many times, has reached $1 trillion a year and growing, and is still resetting at higher levels. But corporate debt, and in particular corporate real estate, with just under $1 trillion of that debt load resetting this year. So you literally can't have rates this high. And I think the markets and investors in general are voting that way with their money, with the expectation that the Fed really does have to cut, even though inflationary pressures could return, and even though the economy still seems to be going in fairly good fashion. In the metals specifically, there are some other factors, particularly gold, that are very interesting. We have seen strong buying in China, which we typically don't see on a price rise, but because there aren't many alternatives in China right now, we have a nascent economic slowdown there. You see a lot of money going into gold domestically. And we have central bank buying that is supporting the market, and that is not price sensitive buying. So that's two factors that I think help spark the rally in gold. And as we speak, we're starting to see Western investors finally chase the price higher. The holdings in GLD over the past few days bottomed and are now growing at a fairly rapid rate. And that's a great proxy for Western investment demand. So if we have all three of those sectors buying gold at the same time, I would hate to be a short standing in the way of that.
Let's talk more about that U.S. demand, because it really has been the one thing that's lacking. But you just mentioned GLD there. You can also look at some of the gold ETFs like GDX, GDXJ. Those have seen higher volumes. The majors have also seen a bit of an uptick in share price and in volume. Really, a lot of equities have seen that uptick. What else are you watching on the Western demand front that could signify that there is more interest here, and maybe that interest could be growing?
Well, the open interest on the COMEX started responding with the gold price. Now, that obviously includes shorts as well as longs, so it's really a gauge, not as much of buying, but of interest in the sector. But I think the shorts that pile into gold and silver just keep having it handed to them, and I don't think they want to get in the way of this freight train. We are seeing, as we speak, a bit of a setback or correction in the gold price, and particularly in silver. But I don't think that's anything to be feared, like we have in the not too recent past. We always fear a big slam down in gold and silver. I think the buying has been so broadly based and strong, and again, price insensitive in gold, that I don't think we're going to see that. I think this isn't hot money that's going into the metals right now, and that's exactly the kind of buying that we really want and need to see to have a sustained secular bull market. And again, I think that's what we have begun here.
Well, Brien, when you dial down into the stocks, especially the universe of, let's say, the junior stocks versus just the majors, and I guess you could carry that up into the mid tiers too, are there any areas of the gold and mining stocks that you see having a better setup? Are you more partial to silver over gold? Do you like explorers versus the developers versus the producers? How are you looking at the different segments of the precious metals equities?
Yeah, I think the grassroots exploration plays will be the last to move, outside of a few exceptions here and there. There are explorers that have been getting good results, and some that have some resources that have been doing very well, that we've been recommending in Gold Newsletter. And there are some special situations again here and there. But I think generally speaking, the companies that have big resources already in hand seem to have been responding first or earliest here, and especially the ones that look like they can build upon those resources. I think they're starting to do better. But again, this is just the beginning of this trend. We really have, as you both have mentioned, a lot more room to go, not just in the course of this bull market, but just to catch up to the same kind of enthusiasm that we've seen in the metals. The mining stocks have, in fact, leveraged the move. They have been outperforming gold, but it's not been to the degree that we think they should have. There are still bargains replete in the sector everywhere you look, even though a company has been up 20 or 25% over the last week or two. they're still dramatically undervalued. And in fact, the ones that have been the early movers, those are the ones that have the market's attention. So they're very likely to be the better plays right now.
Yeah, a lot of these stocks, even though they have gone up 20, 30%, many of them are still even down for the year. So then, Brien, what are you watching most closely, again, to kind of confirm this sentiment shift? Is it the major gold miners continuing to get a bid and maybe them starting to break out? Is it GDX finally starting to break out of its longer term downtrend? Or is it maybe bigger deals being announced for the sector, different news coming out of these companies? What are you on the lookout for?
I'm on the lookout for generous money coming into the sector. That's what we really need to light things up. And what you're going to see is obviously the indices GDX, GDXJ responding to that. They again have actually been leveraging gold, but you want to see a lot of money coming into that sector. You want to see it into the majors and the big producers, and then start filtering further down the food chain into the juniors. We have seen decent responses in the majors and not a homogenous response, because each of the companies have their individual different individual situations, but we have added about $150 to their margins over the past week or so, and that's significant. And I don't think that we've seen that reflected yet in their share prices. When that starts to happen, that's going to be the first sign that the generalists are taking advantage of that, or really paying attention to it. Right now, we still have a lot of competition from, U.S. stocks. We have the AI plays. We have the Magnificent Seven or Magnificent Five or whatever it's down to now. But we have a lot of competition out there for the dollars that would have been more readily flowing into the gold and mining sector. All that said, there's a lot more dollars out there these days, and we only need a small fraction of that available capital to be diverted and allocated toward the sector to really get an outsized, even explosive response.
Well, Brien, when you think about news flow, as you mentioned, the margins are getting better for the producers. So we'll be looking at how their Q1 production numbers go in a month or two, and just to see how the first quarter wraps up. They should be making more money, generating more revenues. But when you go down to the pre-revenue companies, the developers and explorers, the prospect generators, I've never seen the sector this dead on news flow. You got your finger on the pulse in the sector. You talk to a lot of subscribers at Gold Newsletter. You talk to a lot of the people at the conventions. What is the environment going to be like this year, where so many companies have failed to even raise money yet to even do a work program, but then there are other companies that are cashed up and they're going to be blazing forward? Is it going to be a tale of two cities, or a tale of the haves and have-nots?
Well, yeah, it has been a tale of haves and have-nots, but I think the have-nots are sensing a shift in sentiment, and most of the news that I've seen lately has been of financings. So you see a lot of companies that are coming to market now. Some that started, to their credit, in late last month, that are still raising money or just closed financings. But I look at the recent PDAC conference as a great gauge for how things have evolved. I was at the Metals Investor Forum giving a presentation on the Friday before the PDAC, which began on Sunday. And that's the day that we had that big run in gold, shortly after I got off the stage of my early morning presentation, actually. And so gold popped $40 that day. And you look around that conference and people were still skeptical and worried and waiting for Mr. Slammy to come. And yet Monday, when PDAC opened up and we're up another $20 or $25 on the gold price, you saw that skepticism kind of shift to hope. And on the next day, we saw it go more toward excitement. So there was kind of a microcosm of how the market gets affected, has been affected by this remarkable rally in gold and silver. I think that it's going to continue. Frankly, I think we would have gotten a bigger reaction by now, and I think everybody agrees, if we would have thought back a month ago that if gold is going to add a couple $100 to its to the price, what will the reaction be in the juniors? I think we would have thought that they would have been absolutely on fire by now. And they haven't done that, but they have recovered and they have begun to recover and they have responded and leveraged the move in gold. So I'm thinking it's just going to be a matter of time for us to actually prove this to the market that this is a new era and people need to get used to it and get positioned.
So, Brian, down to the junior stocks then, I've noticed, a couple financings, a few more financings being released since some of these companies are either already cashed up or going to be a bit better cashed up. Do you want to see the juniors in your portfolio or the ones that you're watching start major work programs, actually go out there and say, we think this is a bull market, we're going to go do some significant work this year rather than the trend we've seen of less work from last year?
Yeah, I want these companies to drill, if possible, at least make some big news. I think they need to go out and get active. The smarter companies have been sitting on their cash, doing some of the boring things that the market wouldn't reward them for anyway, towards permitting and environmental studies and all of that stuff that the market really doesn't care about. But they still have cash and they can mobilize toward drilling if the market is going to be receptive to it. And I think it will be. It's going to be a lot more receptive now than it was a month ago. And I think in another month, it's going to be much more receptive to that. And it takes a while to mobilize drill programs. So I think companies really should start getting to work now, or they're going to be left behind.
Well, just following up on that, over the last couple of years, there's a lot of companies that have resources that have gone out and done a lot of drilling, sometimes tens of thousands of meters, even up to hundreds of thousands of meters if you look at it over a couple of years. And they spent a lot of money that they had raised and built a lot of value, but they didn't get rewarded for it. Do you think that in a different dynamic here, where we're really in the next leg of the bull market, that companies that go out and do those big work programs are going to start getting rewarded for it? Because a lot of investors feel like they almost wish the companies wouldn't have raised so much, wouldn't have drilled so much, and wouldn't have expanded their resources so much because it actually didn't reflect in the share price moves.
No, I think those companies that are showing this big resources have set themselves up to be the first to move in this new rally, in this new bull market, and really the first to be looked at by the majors if and when we see some M&A activity coming about. So yeah, I think they should have done what they should have done. I would have agreed and did agree with these companies that toward the back half of last year and early this year, it really didn't pay to be aggressive on drilling because the market was not rewarding those results. But it's a completely different market environment now as it was a couple months ago. And so with those resources in hand, it's much easier for the market to evaluate and value the companies and see that some of them should be trading 4 or 5 times higher if we're in a typical market environment, much less a bull market. And we are in a bull market. So these companies could be going up 5, 6, 7 times in value as the excitement builds. And it's very easy to look at it and say if a company's got, a few million ounces of gold or 100 million ounces or more of silver, they ought to be valued very easily. It's easy to calculate that they ought to be valued at a multiple of where they are today.
So, Brian, within your portfolio and your newsletter, the Gold Newsletter, are you shifting any positions around? Are you recommending more stocks to your followers? What are you doing to play this potential early move in the equities?
Well, I'm looking at special situations in some ways. And in Gold Newsletter, we were able to recommend a few companies before PDAC and shortly thereafter that have done very well since then. Some of these are companies that have maybe not established resources, but found a lot of gold and were just trading at ridiculously low levels. Some are on the trail of really building resources. So still, I don't approach it in a thematic way. I look at every company on its own if I would look at a theme right now, I would say that some of the junior silver companies, because I expect gold to keep rising and because I expect silver to keep leveraging that move, I think the junior silver junior companies have a good chance of duplicating the kind of performance they had in the spring of 2020 when they were just absolutely explosive to the upside. I think we could see that very soon in that sector. So if I had to come up with a theme, I think that would be one that I would recommend and urge people to look at.
So, Brien, before we get you out of here, then, any individual stocks you want to share with our listeners?
Yeah, I look at Vizsla Silver. I think that's still, it's a silver junior, but it has a really tremendous resource. I think that's a great one. I think Erdene Resource Development is a great partner. It's in Mongolia, but it has a great gold project and is closer to actually starting production than I think even they expect. And it's one of those ones you look at it out there and it's a prime M&A candidate. But regardless, over the next 12 months, they're going to actually get into production, I believe. And that's one I think that's really due for a re-rating. Aftermath Silver is making some news recently, or will be. It's raising some money right now. So I think that's a bit of a depressant on the share price. But that's one of those junior silvers that could take off, and it has taken off in the past from these levels when we've had a response in the silver price. So I think that's a good one as well. And in generally speaking, it's that kind of a market again where you need to be positioned. I think we're going to have over the next few weeks, these stocks are really going to start responding, and you want to be in them now.
All right, Brien, always great chatting with you, and even more fun chatting with you when these markets are moving higher, especially the gold and really precious metals stocks. Let's hope this rally continues because it has been pretty broad-based right now, along with a number of other markets continuing higher. Again, if you want more information on the upcoming New Orleans Investment Conference, click the link below. Let us know if you have any questions for Brien regarding that conference. Brien, thanks for your time today.
Thanks, guys.